This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. So the metrics look great. Unemployment's at all-time lows, 3.6% last month. Workers have been trading up to better jobs. And with solid wage gains, household income is at historic highs. Retail spending has been robust, and household debt is manageable. And if you own your own home, you probably have your address bookmarked on Zillow so you can check the latest estimated value. Unfortunately, it looks like the good times may have already peaked. At least that's what the stock market is now telling us. Even before the storm clouds of inflation, rising interest rates, and fallout from the war in Europe began to accumulate, growth was slowing. High stock prices and high earnings expectations were already pointing to a tougher year for stocks in 2022. The pendulum of investor sentiment always swings too far to the upside in good times and overcorrects to the downside when things get tougher. While we anticipated this year to be more challenging, we're always a little surprised at just how fast the market can decline. The S&P 500 is now down nearly 20% from the start of the year. The decline, it's been painful, but it's critical to keep in mind the bigger picture. Long-term gains for the S&P 500 have been great. 8.8% annual returns for the last 15 years. 13% annual gains over the last 10 years, greater than 12% in the last 3. The decline this year is disconcerting, but hardly puts a dent in long-term stock performance. The stock market is often volatile. In the short term, as sentiment, both positive and negative, it tends to get carried away. To be a successful investor, it requires a long-term view and patience and some diversification. So why is the market selling off now? Even before the pandemic, the economic expansion that began after the 2008 recession was historic in its length. And then the pandemic hit. The self-imposed economic shutdown caused a brief recession, but it was unlike any other. It was as if someone hit a pause button. Consumer spending habits changed momentarily, causing economic dislocation, but demand never really went away, and the economic stimulus thrown in the economy was completely unprecedented. More than $3 trillion were distributed to businesses and consumers, and with interest rates near zero, everyone borrowed even more money. We threw gasoline on the fire to make sure we didn't repeat the slow economic recovery after the 2008 Great Recession. This chart shows the obvious spike in household income from the pandemic stimulus. There's very little relative change in income from the meager stimulus package after the 2008 recession, while the 2020 impact, you can see here, is tremendous. The rise in household income coincides with increased economic activity, which should be no surprise. Here's the monthly retail sales figures over the same period. The slowdown in the 2008 recession is apparent, but if you compare that to the rapid reacceleration in retail spending in the fall of 2020, there's a big difference. Flush with cash, we accelerated consumer spending, and that's continued into 2022. Meanwhile, excess capital has been pouring into increasingly speculative investments. And now maybe we're poised for a hangover. Between manufacturing disruptions, distribution complications, and strong demand, there are lots of product shortages. Commodities from fuel to food are more expensive. And with unemployment at 3.6%, the tight labor market is pushing labor costs higher. In hindsight, maybe double-digit inflation should not be so surprising. Interest rates are coming up. They have to come up. The stimulus that accelerated the economy in the pandemic is being taken away, and the hangover is now. More speculative investments with high expectations but little earnings are falling the fastest. Valuations are being reduced across the board, but growth stocks that have outperformed in a strong economy are now underperforming the more boring but reasonably priced value stocks. Over the last 5 years, growth-oriented stocks have significantly outperformed value, gaining 81% versus 37%. This year, with a reset in valuations, the trend has reversed. This chart compares the growth versus value stocks in the S&P 500 since the start of 2021. The basket of value are up 11%, while growth stocks have given back all of their gains over the period. The more speculative the company, the bigger the reversal. But even the leading technology companies are getting hit hard. Microsoft, for instance, down 22% this year. Apple, down 17%. Google is down 21%. Even Tesla has lost a third of its value. There are parallels that can be drawn to the 2001 dot-com bubble bursting. Uncertain business models with high valuations are getting hit the hardest. We have Netflix down 72% year to date. Lyft is down 58%. Peloton down 65%, and Bitcoin trader Coinbase has lost 79% of its value this year. In any downturn, investors renew their focus on earnings and the viability of the business model. This chart tracks the forward price-to-earnings multiples in the S&P 500 since 1988. The long-term average over this period is 16 times earnings. If the economy slows significantly, earnings forecasts will be reduced and prices will have to come down even more than they have already. Despite the sell-off this year, the 17 times forward earnings multiple we're currently at does not appear to be inexpensive. Stocks are not yet cheap. A recession would not be terrible, a normal recession that is, not a 2008 recession. We can't say with any conviction that a recession is even imminent, but growth is certainly slowing and there are good reasons to be cautious. The prospect of slower growth is providing a reset in valuations. Good companies will move forward and stock returns will be positive long term. In some of the questionable business models, they're not going to work out, but it is very possible for the market to get worse before it gets better. It will get better, however. We have reduced exposure to more speculative, high price-to-earnings stocks. We've increased ownership of value-oriented and high dividend-paying stocks. And we've raised cash, but with high inflation, we'll want to put that cash to work before too long. So for this year, the major U.S. bond index is also down more than 10%. Bonds paying little in interest don't perform well when interest rates are moving higher. However, as rates move up, bonds are starting to look more attractive than they have in the last several years. Real estate performance often lags the stock market, and with 30-year mortgages now above 5%, we expect residential real estate to start to decline later this year. So we're looking for a peak in inflation. That's one economic signal that we'll be watching for. The more important one will be expected downward revisions in corporate earnings. And after those expectations are reset lower, then it'll be time to return to growth stocks. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list so you can receive our reports directly in your inbox. Thank you for watching.